Welcome back. Time for our business news. Editor Owen Fairclough's here with the markets a bit depressed as Portugal reminds us the Eurozone crisis is far from over. Owen.
A general strike there today, Louise. We'll get into the details of that in just a moment. But as you say, the European market's opening up just a little bit depressed. Remember, oil prices are high at the moment. Oil, if you like, is the new Greece in terms of the kind of worries that it generates among investors. We've had some data out as well. Just here in France, manufacturing index down. Maybe that hints at a contraction for the French economy, or so the thinking goes. But you can see there, London, Paris and Frankfurt just a fraction down at the opening. The Asian markets, trade surpluses managed to save the day. In Japan, at least, with the Nikkei ended the day just over the line there, pretty flat. Against all expectations, the Japanese government recorded a trade surplus for February. We've been seeing a trade deficit there, or a couple of trade deficits, some big numbers in the past couple of months, so that was a big surprise. Just while I'm talking markets as well, worth noting that Sony has announced it's selling off its chemical products division for a reported sum of nearly $500 million. Remember, Sony, a company that's had real troubles with the hacking of its PlayStation network, lost lots of monies, now appears to be trying to stem that damage with that sell-off of its chemical division. Let's stay with Portugal for a moment, though. As I mentioned a moment ago, a general strike takes place there this Thursday. Remember, Portugal was the third country to have to go to the EU and the IMF for a €78 billion bailout. This strike is very much, certainly among public sector workers, a reaction against the austerity programme that the government's brought in there. Let's get some more on this. We can cross to London and Miles Bradshaw. He's an executive vice president at PIMCO. Miles, good morning to you. Thanks very much for joining us. Your boss, Mohamed El Erian, said a little earlier this week he thought that Portugal was indeed the next Greece, the next country that would need some sort of debt restructuring. I think you'd be a braver man than me if you contradicted the boss publicly on air. But it does seem a little bit harsh, perhaps. The markets seem to have moved on a little bit from the whole Eurozone crisis.
I think the markets have moved on because there's been a shot of liquidity from the ECB LTROs, but I think it's quite clear that that has not resolved the crisis. And you can go either to the micro detail in Portugal, and you can see that Portugal needs to reaccess markets in order to refinance a 10 billion bond next year. Now, the rules of the game with the IMF is the IMF won't lend money to Portugal unless there's clear financing for at least 12 months. So basically, over the next few months, a decision is going to have to be made about providing additional aid to Portugal or restructuring their debt or what have you. And when you look at the details, in our view, the Portuguese programme is not on track. There's been fiscal slippage last year. There's been rising contingent liabilities. We saw that with the budget data for the first 2 months of the year. And you look at the price of Portuguese debt on the market at 15%, it's quite clear that Portugal is not going to be able to access the market next year. So governments in Europe are going to have to make a decision over the next few months about what to do about Portugal. And that will mean additional aid and possibly debt restructuring. It's going to be a political decision about whether or not to restructure the debt, and it will really depend on the broader European outlook at the time.
Miles, is it actually fair to compare Greece and Portugal? Portugal's basic problem is low growth and competitivity, but these are things that can be fixed more easily than, say, changing a culture of tax evasion that you have in Greece.
The scale of the problem is very different. Greece has a much bigger problem. Let's get the numbers in context. Without PSI, Greece debt would have been heading to about 200% of GDP this year. In Portugal, debt is much lower. So the scale of the problem is different, but the problems really stem from too much debt. In Portugal, it's too much debt on the public and the private balance sheet, and being in the Eurozone with policy inflexibility. An inability to lower your exchange rate means that it's harder to regain competitiveness. Portugal had 10% current account deficits during the boom years, so there was lots of borrowing of foreign capital. So the scale of the problem is different, but the diagnosis is very similar.
Miles, I just want to pick up there what you mentioned about the IMF. You think that Portugal is going to be missing it, or is missing its targets, because the IMF seem to me to be a bit more optimistic about Portugal. They seem to think that Portugal has so far met its obligations. The IMF has dispersed money without too many problems, which is a lot different to the situation in Greece.
Yeah, so Portugal on paper met its fiscal targets last year, but it met it due to an accounting gimmick by transferring pension assets from banks to the state. And so, in reality, Portugal missed its underlying fiscal deficit. Now, it's announced additional measures to hit its target this year. You look at those measures, and the austerity in Portugal this year is comparable to what happened in Greece last year. You look at the IMF growth forecasts, and they're nothing like the scale of recession we saw in Greece. So when we look forward, we see likelihood of continued fiscal disappointment, continued fiscal slippage, rising liabilities from other state-owned enterprises, etc. And so that's where we come to a different conclusion to the IMF.
OK, many thanks indeed for talking to us. That was Miles Bradshaw at PIMCO in London.
OK, well, let's pick up on one or two more of the day's headlines, starting in the UK, where the government has come under fire in its latest budget. The coalition government unveiled what it's called a business-friendly budget. It's cut the top rate of tax for the highest earners while providing billions in cheap loans for small firms. It's also bringing borrowing down by £1 billion in a bid to keep the UK's AAA credit rating. But tax officials say removing tax allowances for pensioners will leave more than 4 million people more than £80 a year worse off.
And it's emerged Deutsche Bank has changed its US operations to beat new financial responsibility laws. The German company has made its Deutsche Bank Trust its main US holding instead of Tarnas Court. It means in the event of a cash shortfall, it can use those funds from its base in Frankfurt, alleviating the need to keep large deposits with Tarnas.
Well, thank you very much for that business update, Owen Fairclough there. Just to leave you with the latest live pictures in Toulouse, we're seeing a little bit more movement there, firemen out and about, and the press seem to be massing there as well. We're still not told why, we're still not told if anything's going on, for example, a meeting, but we will keep across that for you, and we'll be back in 2 minutes.